Here's a bold statement. The August jobs report just shook the financial world, and it's setting the stage for some major moves by the Federal Reserve. But here's where it gets controversial. While the numbers suggest a rate cut is almost guaranteed, the markets aren't exactly cheering. Let's break it down. The jobs report shockwave. Last Friday, U.S. equity markets closed lower, despite a weaker-than-expected August jobs report. Non-farm payrolls rose by a mere 22,000 jobs, a sharp drop from July's upwardly revised 79,000, and far below the forecasted 75,000. The unemployment rate ticked up to 4.3%, the highest since October 2021. This isn't just a blip, it's a signal that the labor market might be cooling faster than anticipated. And this is the part most people miss. A weaker labor market could mean the Fed is more likely to cut interest rates aggressively, but it also raises questions about the overall health of the economy. Rate cut expectations, a double-edged sword. The Fed's next move is all but certain. A 25 basis point BP rate cut at the September 17 Federal Open Market Committee (FOMC) meeting seems almost guaranteed. But here's the twist. If this week's Bureau of Labor Statistics (BLS) revisions come in at the higher end of the whisper range, 650,000 to 900,000, calls for a 50 BP cut could grow louder. This isn't just about numbers, it's about confidence. A more aggressive cut could signal the Fed's willingness to prioritize economic stability over inflation concerns, especially after their dovish tone at Jackson Hole. But is this the right move? Some argue that cutting rates too quickly could reignite inflation, while others believe it's necessary to prevent a slowdown. What do you think? Looking ahead, inflation and market reactions. This week's key event is Thursday's Consumer Price Index (CPI) report. In July, headline inflation rose by 0.2%, keeping the annual rate at 2.7%. However, core inflation, which excludes volatile items like food and energy, climbed to 3.1%. The highest in 5 months. For August, expectations are for headline inflation to hit 2.9%, the highest since January. But here's the catch. Even if inflation ticks up, the Fed's focus on labor market risks suggests they'll still cut rates on September 17th. The question is, how will markets react? Tech and broader markets, a balancing act. The Nasdaq 100, a bellwether for tech stocks, is at a critical juncture. Last week's rally pushed it toward trend channel resistance just above 24,000. If it breaks above 23,969 and sustains above 24,000, it could signal the end of the Wave 4 correction and the start of a Wave 5 rally toward 25,000. However, if it falls below support levels at 22,959 or 22,673, a deeper pullback toward 22,200 to 22,000 could be on the horizon. Similarly, the S&P 500 hit a record high of 6,532 last week, but a drop below 6,360, 6,340, could trigger a pullback toward 6,200 to 6,100. These technical levels aren't just numbers. They're indicators of investor sentiment and market confidence. The bigger picture. What's next? The U.S. interest rate market is pricing in about 68 basis points of Fed rate cuts by year-end, with a cumulative 150 basis points expected by December 2026. But here's the controversial part. Is this enough to stimulate growth without reigniting inflation? The Fed's dovish pivot at Jackson Hole suggests they're more concerned about a labor market slowdown than persistent inflation. But as we await the CPI report and BLS revisions, one thing is clear. The next few weeks will be pivotal for both the economy and the markets. Your turn, what's your take? Do you think the Fed is making the right call by prioritizing labor market risks over inflation? Or is this a risky move that could backfire? Let us know in the comments. This is a conversation worth having.